I've got to say I'm pretty pleased with the thumbnail title for this video. I kind of wish that inspiration had hit me when I was trying to think of a name for my channel in the summer of 2020. But here I am with some hacks to save tax, and I've got some really good ones here for you today that could help you save or make a lot of money, which means more lifestyle, more time to enjoy yourself, and all of that good stuff. If the almighty YouTube algorithm has pushed my mug in front of you for the first time, welcome along, I'm Chris, and for the past 17 years or so, I've been helping people achieve tax-efficient financial independence early. If you want to see videos that are all about that, then please subscribe, hit the notification bell, and let's get into it. Wouldn't it be great if there was a way to carry forward your unused personal allowance when you retire so you could use it to pay 0% tax in a future year? Well, guess what? There is. Your personal allowance ensures that the first part of your income isn't subject to tax. And as I sit here on this rare sunny day in Wolverhampton, that allowance is currently £12,570 a year. Now, many people, clients of mine included, decide to retire in their late 50s and they choose to withdraw their income from non-pension investments such as ISAs first. In a lot of cases, that's pretty sensible because non-pension investments are subject to inheritance tax, whereas pension money isn't. So running those other investments down first can help to reduce that inheritance tax. The only problem with this strategy is that quite often, people will eventually need to draw something from their pensions, even if that's later in retirement. And that tends to coincide with when other taxable incomes, such as the state pension or defined benefit pensions, start being paid. What they end up doing, therefore, is taking withdrawals from non-pension investments like ISAs first, which don't use any of the personal allowance because they're tax-free, and leave themselves with less in that environment later, when it would be more useful to have access to a fully tax-free income. Let me give you an example. For argument's sake, let's say that when you reach state pension age, you're entitled to a state pension of £10,000 a year, and at the same time, you become entitled to a defined benefit scheme income of £5,000 a year. Those incomes fully use up your personal allowance. So any taxable income that you now receive in addition to those will have tax taken from it. We'll assume that you've used up all of the money in your ISA before this point and you now only have money in a SIPP. So if you need £30,000 a year total income, you'd need to take out another £15,000 from the SIPP. But taking just £15,000 won't be enough though, because there'll be tax to pay. You can take some tax-free lump sum, but the total you'd need to draw out to get £15,000 net is about £17,700, meaning you'd pay about £2,700 in tax based on current rates. If you'd still got money in your ISA though, and you kept it in there for longer, you'd only need to draw out £15,000 because ISA withdrawals are always tax-free. What can be sensible therefore is drawing out of your private pensions earlier when you don't have any other taxable income to use up that tax-free personal allowance. This would then preserve other tax-free sources of income until later when they're more useful. I call this personal allowance carry forward. Now also, if you're in a situation where you're a couple and one of you is still earning and meeting all of the household costs, but you both have pension holdings, it can be sensible to withdraw the unneeded income from the other partner's pension up to the value of the personal allowance and then reinvest it into an ISA. That could then provide a more efficient place to take withdrawals from in the future, completely tax-free, instead of the main earner's own pension. You have to weigh this against the inheritance tax benefits of keeping money in the pension environment, of course, though. So it's a personal choice and it comes down to individual circumstances, but this type of planning is really worth thinking about. You also have to remember that taking flexible withdrawals will trigger the money purchase annual allowance, so it will limit what the non-earning spouse will be able to pay into pensions annually. But that's usually a non-issue because they're not earning anyway, so they're already limited. The second of my hacks specifically relates to people who pay higher or additional rates of income tax, and it revolves around physically investing the extra tax relief you receive. For those of you who don't know how higher rate tax relief works, you claim it by completing a self-assessment tax return and telling HMRC what level of personal pension contributions you've made. Now normally if your earnings exceed £50,270, you pay tax at 40% on income above that level. But if you've made private pension contributions, HMRC adds those on top of your basic rate band. So let's say you've made gross contributions into your pension of £10,000, you would only start paying higher rate tax on income above £60,270. That means you can earn more money at a lower rate of tax. And in that example, save yourself £2,000 compared to if you hadn't made those contributions. Now that's money that actually goes into your pocket because it increases your net monthly income. The problem is, most people just accept the extra income and it ends up getting spent. If you decided to invest that extra relief into your pension too though, it would make a big difference. So let's take that same example and say that you just resolved to invest the extra £2,000 a year into your pension. With basic rate tax relief added at source, that £2,000 will be grossed up to £2,500. And if that grew at, let's say, 7% a year for 25 years, that would add another £168,700 to your pot. Not money that you'd want to turn down. My third hack is one that I just think is good practice when people reach retirement age and have stopped working, and that is to not stop contributing to their pension. It might not be beneficial if you're exceeding or you're going to exceed the lifetime allowance, but for those of you who aren't, you can still contribute £3,600 a year gross into pensions. And that means you only have to pay in £2,880. Up until age 75, £720 would be added on top for you for free by HMRC. That's £720 that can attract further growth for you. And even though you may have to pay tax if you withdraw money back out of the pension, remember you're able to take a quarter of it as tax-free lump sum, so you'll still usually be in a positive position. To give you an example, let's say you put £2,880 into your pension. As we know, it's immediately grossed up to £3,600. And now let's say you just decided to immediately crystallise that amount. You could receive £900 of it, i.e. 25%, tax-free. The other £2,700 would be subject to tax, and assuming you're a basic rate taxpayer with no personal allowance available, that tax would be £540. So that means that your net withdrawal from that £3,600 is £3,060. That's still £180 more than the £2,880 that you paid in yesterday. That's money for free. If all of your income is coming from non-taxable sources though, such as ISAs, and you are paying £3,600 per year into a pension, if you were to crystallise those £3,600 every year, essentially the £720 tax relief that was gifted to you in the first place could just be kept. You're not allowed to recycle pension lump sum back into a pension, but if you can show that pension contributions are coming from savings that have already been accumulated out of taxed income, then you're not recycling. Imagine doing that every year for a number of years. If there's two of you that can do it, even better. That's £1,440 a year. I'm sure that could pay for a good few flights over the years. Even if you're not planning on spending the money though, your pension is a good place to invest for inheritance tax purposes, because pensions don't form part of your estate value and therefore won't be subject to that 40% tax upon death if it applies to you. Pensions are great vehicles for passing wealth down to the next generation tax efficiently. If you like these hacks to save tax, make sure you drop a little thumbs up below and subscribe for more of this kind of content. I'm off to enjoy the Wolverhampton sun, and I'll see you soon.